Hi guys, welcome to T Account. In the last video we covered inventories, an item of current assets, and inventories are purchased with the intention of resale to earn profit. In this video we will cover non-current assets. They are not purchased with that intention. They are purchased with the intention of using in the business for a long run, maybe for office use or in the production, but they stay there for a long time. A high level definition I have already written to save time, and we have in videos visibility issues. I wanted to be very clear and bold. Now, assets whose benefits are realized over more than 1 year. More than 1 year. I mean, maybe 10, 20 years, but at least it should be more than 1 year. And that normally they cannot be converted into cash very easily and quickly. Of course, if you want to sell something at any cost, you can sell it. But the assumption is they cannot be easily converted. You will have to make a loss. Maybe you may have to accept something much less than their actual cost or their value. Assets whose benefits will be realized over more than 1 year and cannot be easily converted into cash, non-current assets. Okay, the main characteristics of these assets written in your book, but I wanted to explain, are long-term in nature, as I said earlier, should be more than 1 year, are not normally acquired for resale. They are used in the business, in production, in office use, something like that. Could be tangible or intangible. Tangible is something you can see, touch. Tangible assets have physical existence, whereas intangible assets don't have any physical existence and you cannot see, you cannot touch, like trademarks, brands, copyrights, goodwill. These are the assets, long-term assets. They generate revenue for you, but you cannot see them. They are not visible, or you can say physical existence is not there. Or not normally liquid assets. As I said, they are not cash or short-term assets that you can easily liquidate. They are fixed assets like building, machinery and equipment, furnitures, office equipment, these things. So, these are the main characteristics. From here, this is very comprehensive definition. It covers a lot of things. But these are the main characteristics from where you can distinguish between current and non-current assets. Now, the second issue is about their recognition. At what cost you can, book them? What is their, how to present them? First of all, IAS 16, Property, Plant and Equipment, says all costs. What are the costs and expenses that can be added to their, you can say, initial cost? All costs incurred to acquire, meaning purchase price, to acquire and bring in working condition. There, after purchase, if you have to pay freight, legal fees, transportation, carriage, inward, installation costs, whatever is required to bring them in working condition are acceptable or recognizable costs that you add to their cost. Now, this standard clearly gives you a list of items that you can add. Of course, guideline, but mainly you will find these things in the questions as well. So you can basically add their purchase price as discussed in the definition clearly. Purchase price, any delivery costs, if you have to transport it to your warehouse, your location, then legal fees, some license, government approvals, or some documentation is required for which you have to pay the fees. Then any expenditure, incurred to enhance the asset. I'll discuss that in more detail. And costs incurred on trials and tests. Before they start production, you may need to do some trials and tests which cost some money. That cost is also acceptable because without that you cannot use that asset. Any subsequent expenditure incurred to enhance the asset. Any cost, you incur some cost and it adds some value, long-term value to the asset, adds to its capacity or increases assets life or decreases costs related to this asset. So that is acceptable cost. You can add that to the value of the asset. Anything that increases the life of the asset, all these assets other than land have a limited life. So any expense that increases that life is also added to their cost, or something that adds to their capacity. If they can produce 1000 units, and after this increment, after this expenditure, they can now produce 2000, 3000 units. It means you have added some capacity to that. So after each expense you will have to go through this criteria, whether it is from one of these things. If the answer is yes, you can add it to their cost. And there are these you have to include, and these are the things you have to exclude. Clearly, explicitly given items. For instance, repairs, renewals. Renewals are meaning you paid some fees which are paid every year. Some charges that are paid every year, you need to get them reduced. So this is, in that case, that expense is revenue expense for the year, not long-term nature, doesn't add any value, is not being realized over more than 1 year. So you cannot capitalize renewals, repairs, renewals, repainting. That is your choice, what kind of color you want, but it doesn't add value or increase the life of that asset. or repainting, wastage, while trials and tests were going on, you have done a lot of wastage. If that is something abnormal, you cannot recognize it because it will not add any value. That was some mistake, negligence, whatever. Or administrative costs. You have some personnel over there looking after that asset, not accept cannot be added because it doesn't add any value. Then training costs. Training costs, why are they not allowed? Why are they not recognized? Training costs, because training is for the staff. You are spending on the staff, good for human resource. It will add to their personal skills, but they are not your asset. For asset, they need to be controllable. You cannot control the employees, they can leave you anytime. So whatever you have spent on their training, that cannot be added to the cost of this asset. Asset will stay here, they can leave anytime. So high level idea. In addition to that, there are two classifications of assets. I just want to extend this discussion a little bit. Capital expenditure, and then we have revenue expenditure. This discussion is very overlapping to that area. So let's discuss that here. All these costs, all these costs are capital expenditures. Capital expenditure, any expenditure which will give you benefit for more than 1 year, just like non-current assets. And these are the revenue expenses. Any expense that you incur and you consume the benefit during that particular year, that is the revenue expense. Like your all overheads, salaries, utility bills, rent, whatever. Other than these are all revenue costs, revenue expenditure, for which on the maintenance of current assets, to run the business, whatever routine expenses are incurred, they are revenue expenses. Revenue expenses are charged to that particular year in the profit and loss account. Capital expenditure is carried at their whatever book value is there in the statement of financial position. So capital expenditure goes to statement of financial position. Revenue expenses, all revenue expenses which charge to the income statement or profit or loss account of the same year. Now, before we move to the next part of this non-current assets, very important, that part you will cannot ignore, depreciation. But before that, I want to quickly go through an example to test our understanding of all this discussion. Yeah, test your understanding. Which page? 125. 125, chapter 7. Test your understanding 1. Now, In this small test, they are asking for what amounts should be capitalized as land and building and motor vehicle. So whatever we have learned, what I mean, through this example, we'll test whether we have understood something or not. They have given Bilbo Baggins started a business providing limousine taxi services. I'll share it on the screen as well so that you can also see. Limousine taxi services on January 2015. In the year to 31st December, he incurred the following costs. Bilbo incurred some costs, and we need to identify what we can capitalize as land and building and motor vehicle, and what are the items we cannot capitalize. So before I read, I'll start solving as well. Land and building. They are asking for land and building. So we'll identify the costs that we can recognize, and motor vehicle. They will give different costs, and you will identify which costs we can recognize. In office premises, 250,000. Office premises mean they are paying basically cost price, purchase price of office building. Office premises. How much? $250,000. $250,000. Next, legal fees associated with purchase of office. We said we can recognize legal fees because without that we cannot have that office and it cannot come into working condition. So something compulsory, unavoidable. Legal fees. How much? 10,000. What else? Cost of materials and labor to paint the office in Bilbo's favorite color. This is something optional, but is repainting is not allowable expense, cannot be added as we discussed just now. Then Mercedes E-Series estate cars. Cost of the cars, Mercedes. Cost, purchase price, we can always capitalize. How much? $116,000. Okay, next, number plates for cars. Number plate, is it long term or short term? Number plates are purchased, that fee is paid once, and whenever if you have bought a car, you will know this, that when we go for registration, they give you number plate and that registration. So that number plate is one of expense, unavoidable, and you don't pay every year. It's not something annual, so you can add it, number plates. How much? $210. Then it says delivery charge for cars. We have already studied that delivery charge we can add because we need to get the cars transported to our place, our location. Without that, we cannot have them. To bring them to their current location and condition, whatever is necessary, we'll have to pay. Delivery charge is $180. Not that much anyway. What else? Road license fee for cars. Car license is renewed every year. So something annual. renewals are not allowed, so we'll not add this. Driver's wages for first year of operation, first year, second year, third year, wages are not something that adds value to the car or very much required. We can drive ourselves. So that will not be added to that cost, driver's wages. And then blank taxi receipts printed with Bilbo Baggins business name and number. Again, something optional, not necessary, no value addition with this. This is a sort of, you can say, printing and stationery things. So normal revenue expense, you can add it to the costs. Now add this 260,000. That is the total land and building. And here 80 plus 10, 90, 390, 116,390. That is the total cost that we can add for motor vehicle. And this 260 is the total cost for land and building that we can add. So do we have that answer here? Yes, it says A, land and building 260,000, motor vehicle 116,390. So we have understood to some extent this concept. Now for detailed examples of, I'll discuss the depreciation and go through a couple of examples. See the next video for that. Thanks a lot for watching this. Thanks.